The Property Bulletin by London Property, the home of superprime.
Recent reports have suggested that wealthy individuals, particularly non-doms, are fleeing Britain in significant numbers due to fears of higher taxes and the abolition of non-dom status. However, the data tells a different story. HMRC figures show an increase in non-doms residing in Britain, and estate agents report little evidence of a mass exodus. While Britain may be losing some entrepreneurs, this trend began long before recent tax changes and is more closely linked to the decline of the UK's financial environment, particularly in raising business capital. The focus on non-doms may be displaced. The real issue lies in the broader challenges facing Britain's ability to attract and retain wealth creators, a problem exacerbated by the decline of the FTSE and the fallout from the financial crisis. As Britain seeks to retain talent, upcoming government policies will need to address these deeper issues, with lessons to be learned from California's struggles to retain its entrepreneurial base. The London luxury home market, once bustling with high-end transactions, is now increasingly reliant on wealthy Americans to maintain momentum. The recent sale of a £32 million Notting Hill mansion to an American buyer highlights this trend, as political and social challenges in the US, coupled with a strong dollar, drive more Americans to invest in London real estate. Unlike 3 years ago, American buyers are now more decisive, opting to purchase rather than rent, with some citing concerns like gun violence as key factors. This shift is significant, as US buyers now account for 6.1% of London home purchases, up from 3.3% in late 2023. The appeal of London's luxury market is also boosted by a weakened pound, making properties more affordable for those with dollar-based wealth. Estate agents are increasingly targeting American buyers, with marketing efforts and property roadshows in major US cities like New York and Miami. Despite the challenges facing London's luxury housing market, such as higher taxes and rising interest rates, the influx of American buyers offers a much-needed boost. However, uncertainties remain, particularly with the upcoming US election, which could influence the decision-making of potential American buyers. Some are preparing for a possible return of Donald Trump to the presidency, a scenario that previously spurred an increase in American purchases of high-end London properties. As the political landscape evolves, the future of London's luxury real estate market may hinge on these international dynamics. The Leasehold and Freehold Reform Act 2024, set to take effect in 2026, introduces major changes aimed at benefiting residential leaseholders in the UK. Key reforms include the abolition of the marriage value, which previously required leaseholders with less than 80 years remaining on their lease to make additional payments when extending their lease, thus reducing the financial burden on them. The Act also extends the standard residential lease term to 990 years, providing long-term security and making leasehold properties more attractive. Additionally, the Act enhances leaseholders' rights by allowing them to extend their lease or purchase the freehold immediately upon acquiring the leasehold title, eliminating the usual waiting period and relieving them of the obligation to cover landlords' legal costs. These changes are expected to make leasehold properties more accessible and affordable for leaseholders, though they may lead to reduced income and influence for landlords. A London-based firm, Northwind Capital, backed by a trust linked to Russian tycoon Boris Mints, is making inroads into the UK property market by providing financing for deals that traditional lenders avoid. The firm has developed a niche by issuing bonds backed by elite UK properties, which are listed on the Vienna Stock Exchange, and by using profit participation notes to give investors ownership stakes in high-end properties. Despite operating legally, Northwind's complex financial strategies and ties to Mints, who is embroiled in legal battles in Russia, have raised concerns among potential investors. The firm has been involved in several significant transactions, including the purchase of properties in London's Belgrave Square and Mayfair, further fueling interest and scrutiny. With Labour's election win, a new Energy Performance Certificate (EPC) target has been set, requiring landlords to upgrade their properties to an EPC standard C by 2030. The cost of retrofitting private rental sector properties across England, Scotland and Wales is estimated at over £24 billion, a significant burden for landlords. A survey by Skipton Building Society indicates that 39% of landlords may consider selling their properties instead of investing in upgrades. To prevent a large sell-off and ensure tenants have homes to rent, the industry must collaborate on finding a mix of grants, tax incentives and interest-free loans to support landlords in meeting the new standards. Additionally, controlling inflation and addressing the looming skill shortage in trades essential for retrofitting are crucial to keeping costs down. Of course, another alternative to causing all these unintended consequences might be to relax or scrap the targets. The government is urged to work with the industry on these issues, including developing a workable exemption scheme for properties that cannot be feasibly upgraded. Collaboration between landlords, the government and financial institutions is essential to meet the 2030 target and avoid negative impacts on tenants.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the superprime property market.